Welcome, everyone, and thank you for joining us today. Today, we're going to spend about half an hour talking about what's new in Social Security this year and what it may mean for you. Quick disclosure to make, the webinar is only for educational purposes. Please talk to your financial professional before you make any financial decisions. So we host these webinars every other week. The last one we did was on estate planning. Next one we have is on how tax planning changes through the 4 stages of retirement. You can find the replays for all of our past webinars and any registrations for upcoming ones at bautisfinancial.com/learning center. On the webinar today, I have my colleague Kira on. Kira is going to be monitoring the chat and the Q&A. So if you have any questions, enter them into there, and I'll take breaks periodically to see if there are any questions out there. Okay, so here are the topics we'll be touching on. Social Security paid a small cost of living adjustment this year. We'll talk about how the COLA is determined, put it into context, and see what it means for you and your benefits going forward. Another number affected by the cost of living adjustment is the earnings test threshold. So this is a question I get a lot of, can I still work and collect benefits? So we'll talk about how much you can earn in 2021 without having benefits withheld if you claim Social Security before your full retirement age. Next, we'll talk about taxes, both the Social Security payroll taxes and the income taxes you may have to pay on Social Security benefits. For those of you with Medicare, we'll go over the new Part B premiums for 2021 and see why it's not such a straightforward number anymore. And we'll also cover dates to watch in 2021 as well. We'll give you an update on the status of the Social Security Trust Fund and discuss some ideas for reforming the system to make it solvent for the future. And then finally, we'll give you an update on some Social Security claiming strategies. Okay, so first we'll start off with the cost of living adjustment. In October every year, the Social Security Administration announces a bunch of numbers that are determined by the rate of inflation over the prior 12 months. The most eagerly awaited number is the cost of living adjustment, or the amount by which Social Security checks will be raised. Another number is the new earnings test threshold, and finally, the maximum amount of earnings on which Social Security taxes will be assessed. So the cost of living adjustment for 2021 was 1.3%. That means that if your current benefit is $800 a month, you're getting an extra $10.40 per month. The higher your benefit is, the higher your COLA will be. So if your benefit is $3,900 per month, which could happen if you're in the maximum earning bracket, and you claim your benefit at age 70, you'll be getting a cost of living adjustment of over $50 per month. But here's the kicker. If you're enrolled in Medicare and having your Medicare premium taken out of your Social Security check, you may not see this much of an increase. Part of your COLA may be absorbed by Medicare premiums. So we'll talk about Medicare premiums in a few minutes. To put this year's cost of living adjustment in perspective, you can see here what the annual COLA has been since 1986. It's a year-by-year breakdown. So inflation has been low over the past years, so the COLA has been low. Going back to 1986, the COLA has averaged about 2.5% a year. The Social Security trustee projects that it will be a 2.4% COLA going forward. But even if you look at the past 10, 11 years, it hasn't gotten close to that 2.4%. And you even see 2010, 2011, a couple of years where, and I think these were the first years ever where the cost of living adjustment was zero. So when you think of it, one of the benefits we claim of Social Security is that it rises as inflation rises as well. But you see in some cases that increase is very small when in fact, you go to the grocery store, you get gas, or you spend money on other things, the rate of inflation may go up quicker. It's supposed to be correlated, but sometimes the correlation is off a little. So I'll explain a little bit how that cost of living adjustment is calculated. It's based on the Consumer Price Index for all wage earners. And that the Consumer Price Index, it measures the change in a basket of goods and services that a typical worker or a typical person might buy. So it covers things like food, transportation, housing, entertainment, healthcare, and pretty much everything that people spend money on. So in any case, the COLA is announced each year in October and takes effect when Social Security checks, starting with the Social Security checks you receive in January. So even if you haven't started your Social Security yet, let's say you're delaying it to age 70 to get a higher amount, your benefit will be raised by the COLA. So when you do claim your benefit, you can be sure it will reflect each year's cost of living adjustment up until that time that you start collecting it. And if you are interested in learning how that COLA was calculated, some people like to dig deep into the numbers. You can visit the website that's at the bottom, and we'll link to this in the replay. This Social Security website explains how the cost of living adjustment is calculated. Okay, so that's the first big number change. Next, we'll be discussing the earnings test. So the earnings test threshold, it's affected by the cost of living adjustment. As you probably know, if you're under full retirement age, which most likely is between 66, 67, and what it does is it goes up as people are younger now, and you're still working and receiving Social Security benefits, part of your benefit may be withheld. And what the formula that they use, or the calculation that they use, is they withhold $1 of Social Security benefits for every $2 you earn over a threshold, which for this year, for 2021, that threshold is at $18,960. Last year in 2020, that threshold was $18,240. So you see it was a small increase this year. So if you're under full retirement age and you're earning less than $18,960 a year, none of your benefits will be withheld. But obviously, you like to comment that trying to earn less money is not exactly a formula for wealth building. So if you are under full retirement age and you have the opportunity and ability to work, it's probably better to earn as much as you can and just delay applying for Social Security. So the new threshold for the year you turn your full retirement age is actually $50,520. And this is up from $48,600. So just to clarify that, there's a difference between the year that you turn your full retirement age and any years prior to that full retirement age in terms of the earnings test threshold and how much you can earn. So in the months leading up to your full retirement age month, so let's say you turn your full retirement age is 67 and you turn 67 in July, the way that the earnings test works and the way that Social Security benefits are withheld, the formula is $1 of benefits are withheld for every $3 that you earn over $50,520. And then again, once you turn that full retirement age, no benefits are withheld, no matter how much income you earn. So while we're on the topic of the earnings test, I'd like to take a quick moment to explain the monthly earnings test. And this comes into play the first year that you apply for Social Security benefits. So let's say you're under full retirement age, again, that's most likely 66, 67, 68, and you file for Social Security this year. And you continue to work and you earn more. And if you earn more than $1,580 in any month, your benefit will be withheld. Then next year, you'll be subject to the regular annual earnings test, that $18,960, which is adjusted for the cost of living adjustment. So again, it's just going to go back to the general recommendation is wait until you stop work. If you're under full retirement age, wait until you stop working to apply for Social Security. That way you don't have to deal with the earnings test at all, not to worry about, is it the year that you're turning full retirement age or are you prior to it? But there obviously are exceptions, and we can certainly discuss them, as individual their individual circumstances. Okay, so having said all that about the cost of living adjustment and the earnings test, let's take a moment to discuss payroll taxes. So the maximum earnings subject to Social Security tax went up to $142,800 from $137,700 last year. So what that means is that higher earners will pay Social Security taxes on more of their earnings or more of their income. But remember that Social Security taxes represent a pretty good investment in the form of inflation-adjusted income that lasts a lifetime. So, a lot of people, we look at it as like that guaranteed pension-like type of, retirement income. So the more earnings you have, the more Social Security taxes you pay, the higher your benefit will be. And remember, as long as you're working and paying into Social Security, your benefit will continue to be adjusted. So if you improve your earnings record, and the way Social Security benefits are calculated, they take an average of your income over your working career. And a lot of people, as they get into their mid 50s, late 50s, 60s, they're at their highest income earning years. So working longer, the other benefit, aside from collecting that yearly salary, is that it will increase your Social Security benefit as those later years are calculated into the formula, and typically they raise your average income over your lifetime. The Social Security tax rate did not change. So as an employee, you still pay 6.2% in payroll taxes on your earnings. So if you look at your W-2 or your pay stub, you'll see something on called FICA tax on there, and part of that is Social Security. If your employer pays the same amount, so that same 6.2%, if you are self-employed, you're going to pay both sides of it. You're going to pay that 12.4% total for Social Security. That doesn't take into account the Medicare tax. That also did not change this year. So the employee's portion of Medicare tax is 1.45% on all earnings. And again, if you are self-employed, you're paying both sides. So that's an additional 2.9% that's going into Medicare that you're paying into. So if we want to do a little quick math on it, if you earn the maximum of $142,800, and when I say earn the maximum, that's if you earn $142,800 or more. You're still, if you earn more, you're still paying tax on the $142,800. So if you do earn that much or more, you're going to be paying about $8,853 in dollars in Social Security taxes. And then if you're self-employed, you're going to pay both sides of it, which comes out to about $17,707. And then again, the Medicare tax is on top of that as well. So this takes care of payroll taxes, or the tax collected, and that's really what goes into funding Social Security and Medicare. So now let's talk about the other part of taxes, which I think a lot of people don't realize, is that there potentially are taxes on your actual benefits. So on that monthly Social Security income that you're collecting, there potentially are taxes on that as well, and they're calculated a little bit differently. So ever since 1984, Social Security benefits, they've been subject to some level of taxation. And what it is it depends on your other income. So all your income, again, whether you're working, whether you're taking IRA distributions, whether you have rental properties, it all gets lumped together. So here's a table that shows the taxation of Social Security benefits based on various income levels. And then, like I said, income in this case is considered provisional income, which includes your adjusted gross income plus 1/2 of the Social Security benefit, plus any tax-exempt interest. So if we look at the different brackets here, if your income is under $32,000 for a married couple, none of your Social Security benefits are subject to tax. If your income is between $32,000 and $44,000, up to 50% of a married couple's benefits are subject to tax. Again, it doesn't mean that you're paying 50% tax on the benefit. It just means that 50% of the benefit is subject to tax as ordinary income. And then if your income is over $44,000, up to 85% of your benefits are subject to tax. And then if you're a single individual, not married, those brackets are $25,000, $34,000, and then obviously anything above $34,000. So in the case of if you're married filing separately and living with and you live with your spouse, there is no income level brackets. They just assume that, okay, something's going on. We're just going to subject 85% of your Social Security is taxable, regardless of what your income is. So most of us just got done filing our tax returns. And if you do want to see what your adjusted gross income is or what they're using for this calculation, it's line 11 on your 1040 tax return. And typically AGI includes your wages, dividends, capital gains, business income, retirement distributions, as well as obviously any other income. And then what they do, the A stands for adjusted. What they do is they back out such things as student loan interest, alimony payments, contributions to a retirement account, and that's how they come up with that line 11 or that adjusted gross income. So one thing interesting is that these income levels that we're looking at on the table, they were never adjusted for inflation. So what happens is that more and more people are having to pay income taxes on their Social Security benefits. So it's one way that the government can just collect more money on taxes without saying, okay, we're making a change and we're adjusting it for inflation, like a lot of other things are adjusted for inflation. So I guess to summarize all this, the one thing to think of is that up to 85% of your Social Security benefit may be subject to tax, depending upon how much other income you have. All right, so Kira, we'll take a stop there. Any questions that we have right now?
Yes, so 2 questions. The first is on the last slide, or I think it was 2 slides back. For the maximum income that is approximately $142,000, does the top 1% pay more than $8,000 in taxes, or are they capped at approximately $8,000?
Yeah, so they're capped at approximately $8,000.
Okay.
And we're going to talk a little bit about this in one of the because one of the other topics we're going to talk about is the Social Security Trust Fund going to run out in the future? And they run this test every year where they project how long will Social Security last. And what they're looking at is different reforms to Social Security. One of those reforms that they're looking at is increasing that cap. So right now, like you said, it's capped at the 142, but they might say, well, they might have unlimited cap and just say, if you earn $1 million, we're going to tax you, you're going to pay Social Security tax on $1 million. So right now it's capped. Potentially that cap may raise or may be unlimited at some point in the future.
And second question is your benefit raised by annual COLAs, cost of living adjustments, even if you haven't started receiving Social Security yet?
Yeah, so the answer is yes. So, and we'll look at a quick example. So let's say you're 62 years old now, your full retirement age is 67. And at that age, you're projected to have a Social Security benefit of $2,000 a month. And that's, again, they're projecting that at age 67. But from 62 to 67, let's say there's some cost of living adjustments, or let's say it's that assumption of 2.6% every year. When you hit 67, your benefit won't be only $2,000. They take the cost of living adjustments into account, and it'll be $2,200, I think 70 or 73 at that point. So yes, that is one good thing about Social Security, is that even if you aren't collecting benefits, you still get credit for the cost of living adjustments that they do announce. Okay, so back to the changes. One of the things we're going to talk about are RMDs. So let's say you have this income tax situation all figured out, and then you have to start taking required minimum distributions from your IRA or from your retirement account. And if you don't plan ahead, what these RMDs can do is they can bump you up into higher tax brackets. So in addition to having to pay the income tax on the RMDs, they may actually cause you to pay more tax on your Social Security benefits too. So one change that did occur in RMDs is that the minimum age that you had to start taking RMDs, it previously was 72 years old. So, and this I get questions on a lot, where someone will say, well, I have an IRA, I'm turning 72, I don't need the money, why do I have to take a distribution from it? And the answer is very simple, because Uncle Sam has given you this tax deduction and being able to defer tax on this money that you've put into a retirement account, and they just want to collect their money. So they're going to start forcing people to collect money. And by taking a distribution, it forces you to pay tax on that distribution. So that's why tax planning in retirement is very important. And to plug our next webinar, it's how tax planning changes through the 4 stages of retirement. You really want to plan for those tax brackets, because you have all this different income coming in. You want to be careful you don't get bumped up into a higher tax bracket, or how can you leverage what bracket you're in? Maybe you're in a low bracket, and maybe it makes sense to convert some of the IRAs into a Roth IRA, and you're paying a little tax now, so that in case in the future tax brackets do go up, you're hedging against that, and you're paying your tax now at a lower rate than in the future. So the RMDs are a part of it. And again, when it comes time to Social Security, RMDs, retirement income, you kind of have to piece everything together and look at everything at the holistic level to see what the impact is gonna be. Okay, so if you're in advance of your 72nd birthday and you want to start drawing down, so some people say, they get to that retirement minimum required minimum distribution age and they say, I don't want it. Other people, you can start collecting from your IRA at age 59 and a half. So you can start collecting early. Actually, I'll take a step back. You can take money from your IRA at any time. You don't have to pay a 10% penalty if you collect after you're 59 and a half years old. So again, one of the things that you do want to look at, and remember, I talked about the longer you delay collecting your Social Security benefit, it grows at about 8% per year. So you do want to take that into account when you're deciding when to start collecting. But again, if you're not collecting Social Security and you're retired, you have to figure out, where am I going to get that other money from? And a lot of times that means taking money from a retirement account or an IRA, which then triggers a taxable event. So again, retirement income planning can get complex, but you do want to look at everything, kind of at a whole, and then kind of drill down into, how am I going to build my paycheck every year from all these different sources, whether it's Social Security, an IRA, a pension, some deferred money, a rental property. There's lots of different options out there. You just want to look and make sure you're not making a decision that's going to trigger an adverse tax consequence down the road. Okay, so one big legislation change that happened at the end of 2019 was the passing of the Secure Act. And this was a big sweeping legislation, especially on the retirement side. But a couple of the provisions that are going to impact probably most of the people that are on this webinar are, one, the RMDs we talked about, being able to, you don't have to take them at age 70 and a half. Second thing is, it used to be when you turned 70 and a half, you weren't allowed to contribute to an IRA anymore. So that changed. So now, people are living longer, they're working longer. If you're still working and you're still earning income, you can still contribute to an IRA past 70 and a half. So it opens up some different strategies that we can, talk about specifically if they do apply to you or if you could utilize them. And then the third big change was that inherited IRAs must be drained now by the end of the 10th year that someone inherits that IRA. So the way it used to work is, if someone inherited an IRA, they could spread out taking money from that IRA along their life expectancy. So if someone was young, if they're in their 20s, 30s, 40s, they could spend that, and they have this beneficiary IRA that's in a tax deferred account. It's got a tax benefit to it. They didn't have to drain it over a specific time. That's changed. Again, this is one where they now have to drain it by the 10th year. They have to drain it. And again, it goes to the government is looking for money, and just forcing people to drain an IRA rather than spread it out over their life expectancy just enables them to get to those taxes on that IRA quicker. So again, it's just something to be aware of. Okay, now let's move on to Medicare premiums. So changes here, the base Part B premium, it's now $148.50 per month. And some people will pay more due to an income-related monthly adjustment amount, which is called IRMAA. So we'll talk a little bit about that. So if you're on Social Security and you have your Medicare Part B premium deducted from your Social Security benefit, there's a hold harmless provision that keeps your check from going down if the Social Security cost of living adjustment doesn't cover the rise in the Part B premium. So as an example, in 2017, the premium jumped from $121.80 to $134. It's a 10% increase in that Medicare Part B premium. But the Social Security cost of living adjustment was only 0.3%. So the few dollars that people got as their cost of living adjustment, it didn't cover the premium increase. So their premium was left at $121.80 plus whatever the COLA amount was. Some people's premium was even lower than that because they had been subject to that hold harmless provision in prior years. This year, the Social Security COLA was 1.3%, while the Part B premium went up by $3.90. So what that means for most people is the cost of living adjustment more than covered the increase in premiums, but you probably didn't really see any increase in your net Social Security check or benefit that you're receiving. So the issue that will be affecting more people is this income-related monthly adjustment amount, which gets applied to your Medicare premium. And IRMAA, it's an extra premium that you have to pay if your modified adjusted gross income exceeds certain thresholds. So in 2021, the first threshold is $88,000. So if you're single, married filing separately, which is up from $87,000 last year. So if you're a married couple, the first threshold is $176,000, which is up from $174,000 last year. And your premium each year, it's based on the tax return you file 2 years prior. So when they look and see whether you're subject to IRMAA, it's not based on current tax return, it's not based on previous tax return, it's based on your tax return in 2 years ago. So for 2021, the premium you pay is going to be based on what you reported in 2019. But what happens is a lot of people's income has changed due to specific life-changing events, such as retirement or something else that may have happened. You can appeal it, and I've helped people appeal and successfully. So if you have reported higher income in 2019 and you have since retired, you can appeal the higher premium. But a couple things to note. One of them is like a one-time capital gain. It's not grounds for appeal. So like if your 2019 tax return showed that you sold a house and had a capital gain, or sold a stock for a big gain, or maybe you sold Bitcoin that year, you're still going to have to pay the higher premium this year. But if your income has gone back down in 2020, your 2022 premium will adjust, and you won't most likely be subject to IRMAA if you're below that threshold. So here's a table that shows the Part B and Part D premiums for different income levels. And again, it's going to based off of how you're filing, single, joint, or married filing separately, and dependent upon what of these brackets you fall under. This will show you what your Part B premium is. If there is an IRMAA adjustment, what your Part D premium, which is your prescription Medicare, and again, what your Part D IRMAA would be as well. And then at the far right, you can see the end column, which shows the combination or what the total you can expect to pay for Parts B and D. So whether you're already on Medicare or you're getting ready to start, here are some quick dates that you just need to pay attention to. And some of these have already passed for 2021. But the Medicare Advantage disenrollment period is January 1st to March 31st. And what this means is that during this time, you can get out of a Medicare Advantage plan and go back to a original Medicare. But obviously, you want to make sure you do go back and get that supplemental coverage if you need it. And by doing that, the original Medicare that people equate it to or think of as the Medigap policies. So you really want to look at applying for a Medigap policy during your Medigap open enrollment period, which is generally the first 6 months after you enroll in Part B. But if you wait longer than that, the one thing that Medigap does have is if you do wait after those enrollment periods, they can look at pre-existing conditions, and you may not be able to get a Medigap policy. So it's one thing to do is just make sure you have all your ducks lined up in a row, or talk to someone about what the strategy is, and just make sure if you are going to drop Medicare Advantage, you have your plan on how you're going to get whatever coverage that you do need for it. The annual open enrollment period for people on Medicare, it's October 15th to December 7th. And what we're going to do is we're going to do a webinar specifically on Medicare and all your different options closer to that October 15th date. So in September, you'll receive information from your current plan about their offerings for next year. One thing to note is plans do change. So instead, and it's easy just to get it and say, yeah, I'm going to continue with my coverage, but it does make sense to do an analysis and look and see whether there are other better plans out there, because like I said, they do change. Your premiums may go up, your coverage may change. There might be new plans that are out there in your area. So you definitely do want to look and see if it makes sense to switch. If you don't do anything, you're going to be re-enrolled in your current plan for another year. And again, that may be fine. You may be happy with your current plan, but it can't hurt to just look and see what the options are out there. All right. So the future of Social Security, and this is what the question that came in about, how much of income is subject to Social Security taxes. We're going to touch on that in this section here. So Social Security, it was designed to be this pay-as-you-go system. Payroll taxes from current workers go into a trust fund, and they're immediately paid out to current retirees. So because baby boomers have been in their peak earning years for a while now, the trust fund has accumulated more than is needed to pay the current benefits. Right now, the trust fund holds about $2.9 trillion, it's invested in these special issue treasury securities. But now we're starting to see baby boomers are retiring in more and more numbers. The trust fund assets, they're generally going to be drawn down. So the question that everyone has is, will Social Security be there for me? So over the next 75 years, cost will begin to exceed income coming in. So again, it's going to have to start drawing on reserves. And there's enough reserves in the system or in the trust fund that it will be able to pay 100% of the promised benefits until 2034. After that, if nothing is done to reform the system, the income will only be sufficient to cover about 79% of the promised benefits. So that's where we're starting to talk about, okay, what are some of those reforms that are going to have to come into place? So again, it's not an imminent danger, especially if you're collecting now or if you're on the verge of starting to collect. But obviously, most people agree that the earlier that reforms are instituted, it's just going to be less painful on everyone. And it's really just a math problem that involves an increase in revenues, a cut in benefits, or a combination of the two. It's pretty simple. So here are a couple of the ideas that have been proposed. One of them is to increase the maximum earnings subject to Social Security tax. So this is the one we talked about. Right now, it's capped at $142,800. So one way to get increased revenue into the Social Security Trust Fund is raise the earnings cap or eliminate it altogether. Another reform proposal calls for raising the normal retirement age. So currently the full retirement age is 66 for someone born between 1943 and 1954, and 67 if you're born in 1960 or later. One of the arguments in favor of raising the retirement age is that people are living longer. So it's a great thing about Social Security is that if you live to 120, it will pay you until you're 120 years old. But the question is, well, if people are living longer, should we just make them delay paying them that initial start of Social Security? But an argument against that is that people whose occupation involve hard physical labor, they may not be able, they may not be able to work past 65, 66, 67, 70 years old. So, like with everything, there's arguments for, there are pros and cons for and against. Another reform proposal would change the benefit formula so that future increases would happen at a slower pace. And I think there would be people that are grandfathered into this. So this would really affect the benefits of future retirees more than, again, someone who's collecting now or on the verge of collecting. And then there's also talk about changing the formula for cost of living adjustments. So this could give retirees a smaller benefit increase going forward, although the changes are expected to be minimal. So I don't know really how much of a benefit this would happen to be. So given there are lots of ways that Social Security system can be reformed, the question is Congress likely to address this issue this year? Some say now that the Democrats have a majority in the House with the Democratic vice president casting the tie-breaking vote in the Senate, they may get around to acting on one of these proposals that we talked about. It may make several changes. They may look at one change. And the crazy thing about this is I've been doing these presentations on Social Security since 2010. So over 10 years I've been doing them, and I talk about this same slide every time about reform and this and that. So, and the same reforms that we're talking about. So it's been 10 years. Congress hasn't done anything in 10 years. The likelihood that they do something this year, it's probably pretty low. I don't think they're going to look at it this year. The other issues they're looking at priority. They see $2.9 trillion in that trust fund, so they don't think it's in immediate danger. The last time Congress made any major changes to Social Security was 1983, and in 1983, the trust fund was within a few months of running out of money. So if you want to take that analogy and say, all right, they're just going to act like they did historically, they're probably going to wait until 2035 before they really worry about making any changes. And not to be an alarmist and say that, oh, there's going to be a problem. It's just this problem has been around. It would make sense to address it now, but it just it seems like it's one of those political hot topic discussions that no one really wants to touch. All right, so to finish up, I'd like to just quickly talk about a couple claiming strategies. So even though these may not affect all of you or some of you, and especially if you've started collecting Social Security, it's not going to impact you. But I do another webinar on Social Security where we really go into some of the claiming strategies and how you can maximize collecting your benefits. So some of you probably heard of a strategy called file and suspend. That's where where there's a higher earning spouse files for their benefits, immediately suspends them because they've opened their Social Security record up. The lower earning spouse can claim a spousal benefit, and real quick, that spousal benefit is half of what the higher earners Social Security benefit is. But there was a budget act passed in 2015 that disallowed most of this file and suspend strategy. So, the last date to use this was 2016. So again, it's not something that most people, there are some people who retroactively were able to utilize it, but for most people, it's not something that you're able to use. But this one is important. This one is called Claim Now, Claim More Later. So this one, if you're born before January 2nd, 1954, you're grandfathered into this one. And what you have to remember is it's not generally possible to take a benefit based on your spouse's record if your own benefit is higher. The way Social Security does it, they look at your own benefit and they compare it to half of your spouse's, and they just give you the higher one. They don't let you decide. But if you're born before January 2nd of 1954, you can actually do this. You just have to wait until your full retirement age and directly specify on your application that you want your spousal benefit only. So how actually would you do this? If you restrict your application to your spousal benefit, you can receive your spousal benefit, again, while your own benefit is growing at about 8% per year. And real quick, I'll give a quick example on that. So we have John, who's 66, with his monthly Social Security benefit of $2,400. Jane is age 66, his spouse, with her benefit at $1,600. So here's what they can do to increase their Social Security benefit. Jane files for her benefit now and starts receiving that $1,600 a month. John files on Jane's record and receives half of her benefit, or $800 a month. This is while his own benefit is delayed and it's building up delayed credits. So when John turns 70, his benefit will have increased to $3,168, and that's because of those 4 years of 8% annual delayed credits. So he gets half of Jane's benefit for 4 years, then switches to his own maximum benefit, the higher benefit at 70. Really, one of the biggest benefits of doing this is the survivor benefit. So if John does die, his higher benefit transfers over to Jane. So it's basically the best case scenario for this couple. But there's no guarantee that it'll be like this neat and tidy. And it depends on your respective ages. In this case, it's easy, they're the same age. So again, one thing I do is during a Social Security analysis for someone is we look at all the different scenarios that are out there, all the different options that someone has, especially if they're claiming with a spouse. And we look at it by year, and we show how much they'll be collecting. Does it make sense to collect now? Does it make sense to wait? And then we also look at what's called the break-even point, which is at what age, usually it's between 77 and 78, will it have made sense if you live past to have delayed claiming your benefit? And usually that's 77, 78. So obviously no one knows how long we're going to live, but if you live past that age, and you wait to collect, it would have been a good decision. Okay, so that takes care of what's new with Social Security. So one of the things I'd offer, as part of this webinar, as part of basically any webinars, we offer a Social Security checkup, which it basically involves us looking at a Social Security statement and again running that analysis on it, and help you look at there's a lot. It's Social Security it can get complex in terms of, it seems like it's simple, it seems like it never changes. When I turn a certain age, I'm just going to start collecting, and it's usually not the best situation to do. So you want to look at if you're still working, if you have other income, what your benefit is, what your spousal benefit is. And what we do is we run an analysis, produce a report, and show different scenarios that show, if you take this approach, here's what your benefits will look like. If you take this one, here's what it will look like. And then it gives you the information to be able to make that decision on when to start collecting. So, real quick, a couple of cases. So in this case, we have a married person who never was added on spousal benefit after their husband filed. So we recently did a Social Security checkup, and we saw that the lower earning spouse was significantly lower than 50% of the higher earning spouse, or the husband's spouse in this case. So, one of the things we suggested is that they go and they claim their spousal benefit rather than their actually full benefit. The other thing we come across, and this one we do come across a lot, is someone who's divorced. They didn't know that they could claim a spousal benefit off of an ex-spouse. So not everyone can do this, and it's potentially being phased out in this budget act that was passed. But some people can still do it, and some people may have more than one ex-spouse, and they might be claiming off of the wrong ex-spouse. So one of the things we look at and just see, are there other options that you have of claiming in addition to yourself, your current, your current strategy, is you just want to make sure you're receiving all the benefits that you're entitled to. And then the other one is, again, on the divorced spouse, is if there's an ex-spouse that's died. So again, they didn't realize that they're able to collect a survivor benefit on the ex-spouse. So now it's not just divorced spousal benefit, it's an actual survivor benefit, which is that divorced spouse's full benefit, which may be higher. So, and obviously it's not gender related. So divorced men are able to collect the same on, if they're divorced as well. So like I said, if you know anyone that wants to receive a Social Security checkup, we're happy to do it. It's a complimentary service that we do offer. Look at claiming strategies, see how Social Security fits into the rest of your retirement income plan. You can call me. You can go to our website, bautisfinancial.com. We do have the ability to set up that, like I said, that free consultation from our website. Yeah, so this concludes the presentation. Kira, I'll check in again. Any other questions that we have?
Yes, there was one question, and I believe you may have answered it, but how long does a marriage have to have lasted to entitle a divorcee to divorce spouse benefits?
Okay, so the marriage must have lasted 10 years. So if two people are married 10 years, they get divorced, they're eligible to collect divorced spousal benefits. And the other question I get is like, how do I do that? I don't talk to my ex-spouse. I don't know what he's doing. And it's actually pretty simple. The same way that you'd apply for regular benefits, whether you do it online at ssa.gov, or whether you call, or whether you go to a local Social Security office, you're just going to tell them, I was married from this date to this date. You might have to, provide some documentation. Any information you have on your spouse. If you have their Social Security number, great. If you don't have it, that's fine too. They'll look it up and they'll determine, what the eligibility is. So yeah, it's something that a lot of people don't realize, but it's an option that's out there. And sometimes it's an option that leads to an increased monthly benefit.
Thanks, Mark. That's all from the Q&A.
Okay, great. And like I said, we're happy to do a checkup or do an analysis on someone for Social Security. And again, if you go to the Learning Center on our website, you can see some of our upcoming or past webinars. So thanks again for tuning in.